Welcome back to the Working Thesis. I'm Maya. Today is Wednesday, July 8th, 2026, and we are looking at the U.S. market close. You think you have the market's current logic totally figured out, and then a Wednesday like today comes along and just scrambles the entire board. Grab your coffee, because there is a lot to unpack.
I'm Theo, and you're absolutely right, Maya. For the last two solid trading sessions, the narrative was incredibly clean and comforting. The story everyone was pointing to was simply that money was rotating out of expensive semiconductor stocks and finding a new, safer home in cheaper software names. It felt like an orderly, logical transition.
Right, and then today, that clean rotation story just broke down entirely, under a genuinely risk-off tape, driven by a very sharp geopolitical escalation in the Strait of Hormuz and some noticeably hawkish Fed minutes. The chips actually bounced. They completely reversed their recent trend.
But the key is how they bounced. They rallied on incredibly light, below-average volume. Meanwhile, the software stocks that had been catching that rotation bid over the last 2 days were suddenly being sold off. And that software selling was happening on significantly heavier volume.
Which completely flips the script. When you look closely under the hood, this wasn't a fresh leg up for semiconductors indicating a renewed frenzy. This looked much more like a low-conviction relief pop-off of some very beaten-down levels.
Exactly. And on the flip side, the distribution in software had real weight and institutional conviction behind it. The rotation didn't just pause today. The mechanics of it entirely fractured. Let's dig into the numbers to see exactly how this played out. One small thing up front. We genuinely love these companies as stories, but we're explaining them, not recommending them.
So treat all of this as food for your own thinking, not financial advice. Stay curious, stay a little skeptical, and make your own calls. The major indices today gave us a genuinely split tape, and the divergence is telling a complex story. Let's start with the Dow Jones Industrial Average. It dropped 1.09%, closing at 52,348. That actually makes it the Dow's worst single day in 4 weeks.
That is a significant pullback for the industrials and the traditional economy names. And the S&P 500 gave up ground as well, declining 0.28% and finishing the day at 7,483. It is, however, still holding on to that 7,450 structural level, which is notable given the news flow.
But then you look at the Nasdaq, and it tells a completely different story on the surface. The Nasdaq actually managed to close in the green today, up 0.2% to 25,871. But we have to add an asterisk there because it was almost entirely carried by that semiconductor bounce.
Meanwhile, the Russell 2000, our proxy for small-cap equities, took a solid hit. It was down 0.88% to close at 2,956. Small caps are uniquely sensitive to interest rates and domestic growth, so they felt the weight of the hawkish Fed minutes immediately.
And the absolute major outlier today was the Philadelphia Semiconductor Index. The SOX jumped 2.23% to close at 12,574. It was pulling the Nasdaq up almost single-handedly while the rest of the market sank.
Rounding out the dashboard, volatility definitely woke up. The VIX climbed 4.8% to close at 16.9. When you see the Dow having its worst day in a month, the Russell selling off, and the VIX rising, while the Nasdaq edges into the green, it confirms that we are looking at a highly fragmented, highly selective market environment.
You really see the reality of those cross-currents when you look beneath the index level and examine the sector breadth. Underneath that flat to slightly green Nasdaq headline, there was a significant amount of broad selling hiding in plain sight.
Breadth is the story of who is actually participating. And today, participation was incredibly poor. Out of the 11 major S&P sectors, only 2 managed to close in the green today. That is a textbook negative breadth reading.
Energy was the clear leader of those two, up about 1.8%. But that wasn't about economic growth. That was entirely driven by the spike in global oil prices tied directly to the geopolitical news out of the Middle East.
The only other green sector was technology, up about 1.2%. But again, as we noted, that was almost exclusively carried by that narrow bounce in the semiconductor names. The other 9 sectors across the market were decidedly red.
The damage was widespread, and it hit cyclical and rate-sensitive sectors the hardest. Materials took the biggest hit of the day, down 2.6%. Financials dropped a steep 1.9%, and consumer discretionary was right behind it, falling 1.8%.
This is why the major indices can sometimes be so deceptive. If you simply glanced at the Nasdaq headline, you might think it was a quiet, mildly positive Wednesday. But if you were holding a diversified basket of financials, materials, or discretionary names, you experienced a very clear, broad-based sell-off.
Let's get to the absolute heart of the day's action, which is the volume story. In the market, price tells you what happened, but volume tells you the conviction behind it. And the volume tell today was fascinating.
Chips absolutely ripped on the surface. We saw CoreWeave jump 7.75% and Nebius spike 10.9%. Now, Nebius had the added catalyst of a NASDAQ 100 inclusion in what looked very much like a mechanical short squeeze.
We also saw Broadcom finish up 4.83% on the back of a reported Apple-Broadcom chip collaboration, and NVIDIA climbed a solid 3.65%. But the crucial, defining detail here is that all of these semiconductor advances happened on decidedly below average volume.
Right. The buyers weren't stepping in with massive, overwhelming size. It was a light volume float upward. Now contrast that exact dynamic with the software side, where the selling was happening on noticeably heavier volume.
Palantir dropped 4.9%. ServiceNow was down 2.7%. CrowdStrike fell 1.8%, and Microsoft slid 1.4%. And across the board, the volume on those specific software declines was heavier than the volume we saw on the chip advances.
That is the ultimate tell for today's session. The bid in the chip sector felt very low conviction, while the selling in the software sector carried real institutional weight. It's a positioning dynamic that completely flips the rotation narrative that everyone was so comfortable with just 24 hours ago.
To really understand the nature of this low-volume chip bounce, we have to pull back and look at the broader context of where these tech stocks are currently trading relative to their recent peaks.
The structural numbers here are actually quite striking. Right now, roughly 69% of the stocks in the S&P information technology sector are currently sitting more than 20% below their recent highs.
Think about the gravity of that statistic. More than 2/3 of the entire technology sector is effectively in a 20% drawdown right now. If we look at specific heavyweight names, the context becomes even clearer. Micron is currently down about 25% from its peak.
Broadcom is down roughly 21% from its highs, and that includes today's nearly 5% bounce. And Marvel is sitting about 30% off its recent peak level. The damage beneath the surface has been substantial.
So when you see these specific names pop 3% or 4% today on light volume, you have to frame it correctly. This isn't necessarily a fresh, high-velocity breakout. It is a mechanical bounce-off of deeply drawn-down, oversold levels.
Exactly. From a purely structural standpoint, this market action looks much more like a lower high forming within a broader, ongoing consolidation phase, rather than the start of a brand new, high-conviction uptrend.
We have to pivot to the macro and geopolitical shock that really set the tone for the risk-off environment today. The U.S.-Iran standoff in the Strait of Hormuz saw a very sharp and sudden escalation overnight.
Just sticking strictly to the factual, geoeconomic timeline here. The U.S. struck around 80 Iranian sites, and in response, Iran hit 86 U.S. bases located across Bahrain and Kuwait. It is a massive expansion of the conflict footprint.
Following that exchange, the U.S. officially declared that the interim deal is over. They did explicitly state that they do not want a full-scale war, but the market instantly moved to price in the severe disruption risk to the Strait of Hormuz.
The energy markets reacted violently. WEI crude jumped about 4.4%, settling right around $73.50 a barrel, and Brent crude spiked about 5.2%. That is a massive, immediate repricing of global energy supply risk.
Interestingly, gold actually fell on the day, down roughly 1 to 2%, which surprised some market watchers who view it as a pure geopolitical hedge. And European equities, which are highly sensitive to energy prices, sold off very hard.
Germany's DAX and France's CAC were each down about 2.2%, while the UK's FTSE dropped about 1.7%. Europe's industrial base is uniquely vulnerable to energy shocks, and the market immediately moved to discount European growth on the back of this Hormuz escalation.
Now, the reason gold dropped despite those massive war headlines brings us directly to the other major macro event of the day, the release of the June FOMC minutes.
The minutes read surprisingly hawkish. Going into this, the market viewed June as a comfortable hold. But we learned today that some Fed officials actually wanted to hike rates in June.
The majority ultimately held the line, but the tone of the discussion was very cautious. Most officials explicitly flagged ongoing inflation risks, and they left the door wide open for the possibility of a future rate hike if inflation simply refuses to come down to their target.
The bond market heard that message loud and clear. The 10-year Treasury yield rose sharply to about 4.57%, and the probabilities for future rate cuts got trimmed back aggressively across the board.
Which perfectly explains the gold move. As those real yields rose on the hawkish Fed language, gold dipped first. The gravity of higher real rates completely overpowered the geopolitical haven bid that you would normally expect to see.
When you combine a 5% spike in oil prices with a central bank threatening to hold rates higher for longer, you get a classic stagflation-light, hawkish risk-off mix. That is a very tough, restrictive environment for broader equities to digest.
While the chips wobbled on light volume positioning and the macro picture got incredibly messy, the underlying power thesis just kept confirming itself today. This remains the most durable signal underneath all the daily noise.
It really is. Bank of America came out today with a stark warning that the U.S. could face a major structural electricity shortfall stretching all the way through 2030. Meanwhile, the PJM interconnection logged absolute record power demand for the July 4th period.
And looking forward, the EIA is officially projecting record U.S. electricity consumption in both 2026 and 2027. But the absolute most crucial data point today was about cloud CapEx. Capital expenditures weren't cut. They were raised.
Bank of America lifted Alphabet's capital spending estimates by about 8% for 2026 and a massive 12.8% for 2027. They also raised their CapEx estimates for Meta and Amazon.
We also saw Singapore's sovereign wealth fund, Temasek, actively lifting its AI portfolio, weighting from 6% toward a target of 15%. And Meta officially confirmed it is building a brand new $9 billion data center up in Canada.
This data proves that the recent volatility in semiconductor stocks is purely a positioning dynamic, not a fundamental one. Demand is clearly still climbing. We are seeing the exact opposite of an AI slowdown. The physical footprint and the capital commitments are expanding rapidly.
Let's sweep through some other currents around the world, starting with the physical inputs required for that massive power build-out. Uranium ran very hot today, even as Bank of America was actively cutting forecasts in several other sectors.
We are also watching a roughly $20 billion materials complex that is currently flashing distinct breakout signals. There is a very real, sustained bid for the raw physical inputs required to actually construct this infrastructure boom.
Looking globally, it was a tale of two extremes. Hong Kong's Hang Seng jumped about 3% after the IMF officially nudged China's growth forecast up from 4.4% to 4.6%.
But as we discussed, Europe was hit hard on war and energy fears. Over in Japan, the yen sank to a 40-year low against the dollar, and their long bond yields hit a 30-year high. That is a massive historic stress point for the Bank of Japan.
In the crypto markets, Bitcoin was soft today, dropping about 1.8%. And finally, a really fascinating China compute note. According to OpenRouter, the weekly use of Chinese AI models inside U.S. firms jumped from about 11% to more than 30%, spiking as high as 46% recently.
That is a remarkable adoption metric. It suggests that the geopolitical borders around compute might be getting significantly more porous at the enterprise developer level than the headlines would lead you to believe.
So that brings us to the big, overarching question of the day, synthesizing all these different threads. Did the chips to software rotation just completely die? Or is today's action just temporary noise?
Based on the evidence we saw today, our read is that this looks much more like a lower high forming than a new, sustainable uptrend. We saw a one-day chip pop on light volume, bouncing off levels where most of tech is already more than 20% below its highs.
Exactly. The durable, high-conviction signal today wasn't the semiconductor bounce. The durable signal is power. The electricity shortfall warnings and the broadly raised cloud capex forecasts keep confirming that physical power generation is the real binding bottleneck.
The software sell-off had heavy volume and conviction, and the chip bounce simply didn't. But of course, we always have to add the humility line here. This is a likelihood game. No one can predict the future. This is just one read of what the setup looks like today.
Always. We look at the volume, we look at the breadth, and we look at the macro tape, and we assign probabilities. Today, the probability leans heavily toward this being a mechanical relief bounce for chips rather than a fundamental high-conviction breakout.
Looking ahead at the calendar, we have a massive amount of fundamental data coming our way that is going to severely test these narratives. ASML and Alcoa are set to report their earnings around July 15th.
Followed right after by TSMC around July 16th. And then we hit a massive, dense cluster of earnings on July 22nd, which brings us numbers from ServiceNow, Tesla, GE Vernova, and IBM.
Microsoft will anchor the end of the month, reporting on July 29th. Outside of earnings, we are also closely watching for SK Hynix's roughly $29 billion U.S. listing, which is expected to happen around July 10th.
And overriding all of this specific corporate data will be the ongoing minute-by-minute headlines out of the Strait of Hormuz. We will be watching exactly how WTI and Brent crude trade on those developments, and whether gold eventually catches a haven bid or continues to be weighed down by those rising real yields.
Those two macro inputs, oil prices and interest rates, are going to completely dictate the risk appetite and the valuation multiples for the broader equity market as we head into these major tech earnings.
Let's wrap it up with the net thesis read. The core underlying takeaway today is that power remains the binding constraint on AI. BOF's shortfall through 2030 call, PJM's record demand, and the EIA's record electricity projections all absolutely confirm it.
At the exact same time, semiconductor demand is completely intact. Cloud capex estimates were just raised, not cut. But priced for perfection chips trade heavily on positioning, and today's bounce was definitively low conviction. Meanwhile, software simply gave back its recent rotation gains on heavier volume.
We are also closely tracking that rising Chinese model adoption as a key China compute angle to keep an eye on. And most importantly, despite all the geopolitical noise, the hawkish Fed, and the tape volatility, no thesis kill criteria fired today.
The underlying structural trends are holding firm, even if the surface level is incredibly choppy. We'll keep watching the volume and the data as it comes in to see how these probabilities shift.
That's it for us today. Thanks for joining us for another market wrap, and we'll see you back here tomorrow. That's a wrap for today. Thanks for thinking it through with us. We're just testing our theses out loud, one day at a time.
Catch you on the next one. Stay curious and tell us where we're wrong.